where were we? What I wanted to show you is first the historical and going from the top to the bottom. How you analyze the three financial statements, how you build them, really. So that it's a logical sequence, and you can start determining your drivers, the key variables that you're going to use for your projections. That's what's key in this first step. So you're having your 5 or 6 years of historicals. We went over how to increase things, how to group sets of columns and or rows. We were going through the income statement, and then I was showing you the way the top line, the revenue line, is built for this company. So this company has several divisions, and I was telling you OPEC is the petrochemical divisions with 4 different business lines. The actual volume, we calculate the growth rates, and then the growth rates will be used as drivers, and then we'll calculate the volumes for growth. Same goes for prices. We, in this case, we have unit prices for the historical period. This is a simplified version. We have the same historical price assumption for the most part. In some cases going closer to 2011, for instance, we have more specific pricing for the average product line, the PET and for nylon. Very similar. For propylene is a little bit higher, and other resins is like in between. And then you have the average unit price. This is the average selling price, or ASP also. It's called ASP. Yes.
Why do you specify the historical prices based on the growth percentage instead of just the price?
It should be just the prices. So in this case, in many cases, what you'll have is this. So you'll start with a total revenue for the division, and you start to build up assumptions on your way back. So you just have line 44 in this case. Okay, you have line 44. You also have the volume by business line. So you need to make, in some cases, you need to make some assumptions and allocate those revenues by line and derive what is the implied unit price. That's what we're doing here. So in this case, there's no actual unit price from the historical, rather than that it is calculated based on historical.
So it's calculated just to make it easier.
Yes, exactly. But it still gives you a sense of how prices have moved. Very cyclical. You can see here during the prices plunged almost 30%. Then another bit in 2009, and then there was some recovery in 2010.
So everything starts from the revenue.
Everything starts from revenue. What we're doing here is we're deconstructing revenues by volume and prices. So volume times prices will be equal to revenues, and that's the key value going forward. And as we look for volumes, we then convert. We have a base price for each line. We make an assumption for each of those lines how much prices will grow into the future, and with that we calculate the future unit prices. That's our assumption. It will grow 5 to 4% in the future. Again, this will be based on analysis. You need to do a thorough industry analysis to put a number in there. But right now, let's focus on the mechanics. You just converted a historical figure into percentage, and then the percentage into a key driver. And you use that driver to calculate the prices. So now, with volumes and prices, you can calculate your revenues and your projections. So PET will be a function of the volumes you're projecting for 2012 multiplied by the prices for 2012. those two figures in turn are a function of the growth rates that you assume. The lines are in blue. So again, the basic drivers will be color coded for simplicity and so that you can navigate your model and it's easy for you to change your assumptions or make sensitivity analysis. You do the same for each of the lines. Price times volume. You add all the different revenue lines for the petrochemicals division, and you have the total consolidated line for that business unit. Okay. And then you can do the same. You can do the implied growth rate year over year, and the implied growth rate for the total revenue line for this business will be a function of how much volumes and prices are growing. Okay. So it's roughly 5% growth for volumes, 4% growth for prices. Based on the mix, it ends up being 8.1%. It's the exact same procedure for the different business units. The next one is called p3.avi. This is auto parts, aluminum block engines. It's a key supplier, tier 1 supplier for the automotive OEMs. So Ford, GM, Chrysler, Volkswagen, BMW are the key clients that they sell this engine blocks to. In this case, what we're modeling, and again, the modeling will be based on the information that is available and what makes sense for this business unit. Petrochemicals, it was by the different resins that have different markets. In this case, we're doing it by the end client, because we know that the different automakers have different fundamentals and different dynamics, and some might grow faster than others. So we have the historical figures for million units. So this is a company that has a installed capacity of maybe 40 million units per year, and it will need to grow its capacity in the future if it wants to sustain the growth rates from each of those OEMs. We have the historical volumes. We translate those volumes into growth rates, and then we take the growth rate as a key driver to calculate future expected volumes for each of those OEMs. We add the totals, and then we calculate the total volumes for the auto parts business unit. And we go to prices here. This is more of a commoditized product. There's not a lot of differentiation by end client or by end market. So we're just taking one global average in terms of the average unit price. We have the historical figures, and with that we make an assumption, and we assume that it's 5, 3, 2, and then 1% growth going forward. And again, we simply, for the projections, multiply the volume that we're expecting by the same price, and we can calculate the revenues by each of the end clients. We add up for all those clients, and then we get the total revenues for that business. The next one is Sigma. This is a processed foods company, branded foods. Cold cuts, cheese products, and milk products. The same mechanical procedure. We have the historical volumes and prices. We translate the growth rates into drivers, and with the drivers we calculate future volumes and growth. We add the total revenue by line, we calculate the consolidated revenue for that business segment. And with that we can also calculate the growth rate for the business segment. Consolidated. Alestra is a telecom company. The drivers here are a little bit different. We have lines, we have long distance and value-added services as the main business lines. But again, we're deconstructing to volumes and prices. So we want to see how volumes are growing for those two segments. Same for prices. Multiply P times Q, you get the total revenues, you add revenues, and then you get the total for the division. And this division grows much slower because it used to be a more mature business. But going forward, in this case, the company has indicated that they want to get into value-added services, like networks and other telecommunication services for corporations, which are much more value-added and have much more growth. So that's why the resulting growth is higher starting in 2013. So that's part of the conversations that you would have with management to guide you and your assumptions and building the assumptions. So with that, we have all the revenue drivers for each of the divisions. The drivers are the assumptions in terms of growth rates for volumes and prices. We have the revenue lines for all the 4 divisions. We add them all, and that is what gives us the total consolidated revenues for the company. And with that, that is why I have this section grouped. You can collapse this section and only look at the total figure. So these numbers is 136, 182, 206. These numbers are a result of the assumptions that you used back in the projections section for each of the divisions. Now going down the P&L, because these are very different businesses with very different dynamics and different cost structures, we want to model the operating costs by segment. And that's what we're doing here. For the historical period, what I'm doing is I am ungrouping the total cost line so that we can show the detail by each of the business units. And you can see that in the historical period we have total costs by division. You add the total cost and that will tie up with the cash cost. So what we're doing is we're excluding the non-cash items so we can have that part of the P&L separate, so we can also calculate and project it on a separate basis. We want to segregate the cash costs in this case. So with those figures, and as you can see here, these are hard-coded numbers. These are from the financial statements or from analysis and data gathered from other sources. And with that, we can calculate those costs as a percentage of the revenues of each of those divisions, so that we have a more or a closer relationship between the cost structure of each of those business units with their respective business lines. So petrochemicals will be different than auto parts, than consumer branded food products. And you can see that in the cash costs as a percentage of revenues. The line that has the worst margins or the highest cost structure would be the petrochemicals. You would expect this because this is a more consolidated, commoditized industry. And the line with the highest margins is the telecom industry because it's more consolidated and there's much more supply side power, at least in the markets in which we're concerned. In this case, we're basically looking at Mexico. Mexico is a fully consolidated market with one dominant player that sets pricing at a much higher level than in other industries in general. So that's why you see this effect when you're looking at the cost structure and the gross margin by business segment. And you want this level of detail because then in your model, what you're going to do is you're going to project your cash cost by division individually so that you can determine a corresponding contribution margin in a more accurate way, rather than just saying it will be a certain percentage overall. You want to go drill down and determine that percent for each of the divisions. We do the same thing that we did on the revenue lines. First we have hard data and we calculate the percentages, and then those percentages are translated or converted to drivers marked in blue, and we use them to calculate the cost by each of the sectors. So in this case we take OPEX, petrochemical division's revenues, multiplied by our assumption, and we determine the cash cost for that segment. We do the same for each segment and add it all. And so now the 78.5% is a result rather than a hard code number. And this gives you a more accurate picture of how the cost structure will behave in the future. Other things that you can do is you can change your assumptions, and if you're seeing margin pressures in the chemicals industry because there's more supply coming from Asia and your spreads are maybe coming under pressure, you can make a different assumption and say, like for instance we have here, the margin will grow, or not the margin, the cash COGS as potential revenue will grow, so your costs will grow at a higher rate year over year. So there's some margin pressure built into this in this case. Or you can say that in the case of, for instance, Alestra, there'll also be some competitive pressure, so they'll have to maybe increase their cost because of the higher value added that they want to offer. You can also do that. Also, what you can do is if you're changing your assumptions on your top line, if you're growing one division more than the others, you also have an effect on your consolidated gross margin and resulting cash flows. So it's important to have this level of detail in your model when you want to run those sensitivities. This section here, lines 184 to 188, is a non-cash item. So as I said, we're segregating the non-cash from the cash items. So this is basically the depreciation of the asset base in each of those businesses. And we're adding all up to the totals for the historical. So this is based on an estimate. And what we're doing is really on a prorate basis. What we're doing is we're projecting one single non-cash depreciation line and then allocating the corresponding part to each of the business units. And I'll show you how the non-cash item is projected. It's further down in the slums of the. So this is one of the points in which the three balance sheets are interconnected and we need to circle the difference. Right, so with that you have your total cost. You have your non-cash with your cash costs, total costs. Gross income will be the difference between revenues and total costs. SG&A. In this case, this is a little bit different than cost of goods sold. Cost of goods sold are typically, for the most part, variable costs. So if your revenues are growing, your variable costs will grow at a similar rate, because all the things that you need to put into the production of resins or engine blocks, you have the same unit requirements in terms of man hours, aluminum, oil or naphtha or whatever inputs you have a fixed amount of inputs for a unit of output. So those are variable. They will vary very directly with the revenues. In the case of SG&A, you have the opportunity of, in some cases, seeing some efficiencies, and those efficiencies will come from the fixed nature of SG&A. So in this case, if you're a conglomerate and you have your corporate office that is servicing all the different business units, all the business units can grow 5 or 10%, but the corporate office will not grow in the same rate. Maybe you have a base cost structure for that corporate office, and it will grow at inflation rate, but not at the same rate as revenue. So in this case, you can assume that it's fixed. So it grows at a different rate, and you want to model it differently than as a percentage of revenue. So that's why we have the two lines. We have the SG&A, which is a historical figure. It's coming from the financials, Y tab. We calculate as a reference point how this compares to revenue. So as a percentage of revenues, 13, 12, 11. You can see there it varies maybe from 10 to 15. And then a growth rate. And what we want to do here is to grow SG&A independently, so as we reflect the fact that this is more of a fixed cost component when the cost and expenses structure for the company. And that's what we're doing. In terms of the drivers, we're converting the growth rate into a key driver, and we're taking the base SG&A and growing it at that rate, and using the assumption in terms of growth as the key driver, rather than having it as a percentage of revenue. And then the percentage of revenue is a result. This is a calculation. Okay? Operating revenues. EBITDA is operating revenues plus depreciation. You go down the income statement and you see items like the minority interest, which we discussed earlier, and get down to the net income. In this case, we also want to look at net income, earnings per share. So for that, we have the shares outstanding and just divide net income by the shares outstanding, and that's your EPS number. Okay. This will be useful later on when we're working into valuation. Price to earnings metrics. So the price to earnings would be the price of the stock divided by the earnings per share in the business. So it gives you a measure of how many years of today's earnings or whatever year of earnings using a reference is the market paying for this company, or your valuations are determining for that matter. Right, so that's the income statement. I will come back to this section here, the net financing part, later, because this is, as I explained, this is where you tie up your three financial statements, depending on your surplus or deficit of cash. This figure here, your interest expense, line 211, will change. If you have a cash deficit, the model, as I will show you later, will indicate that you need to raise debt or equity. But let's say that debt is the default. So you reflect the increase in debt in your balance sheet, you reflect the inflow in your cash flow, and your interest expense has to increase because this is a function of your total debt. So there's a circular reference to it. So I'll come back and explain that in a bit. The net income figure changes obviously because your pre-tax number changes. Your taxes are simply a percentage of that figure, so that will change as well. So that's why net income changes. So that's income statement. Any questions on the income statement? Okay, the next section is the balance sheet. As I mentioned earlier, we want to keep it simple. So we have a very simplified balance sheet with just the key line items. We have the cash line on the asset side, the accounts receivable, inventories, property, plant, and equipment, and other assets. In most cases, other assets would include intangible assets. Also, as I mentioned, when a company has investments outside their core businesses and the company is not a majority owner, that's the line where you would see reflected that in the balance sheet. So it's like the mirror image of the minority owners. So those are the 5 line items on the asset side, of total assets. And then on the liability side, we have accounts payable, total debt. Here I'm simplifying, I'm just saying short-term and long-term debt will be just lumped up in that one single line. You can have that level of detail and expand short-term and long-term debt. You have other liabilities. In this case, all liabilities will include things like pension liabilities or potential litigation that a company might be involved in. Those are the things that are involved that are included here. You can create different assumptions as to how to calculate that line. In this case, yes, and typically that's where you would include it. Unless it's an important part of the business case and you want to have a separate line and you want to have specific assumptions and model them separately.
So for the total liabilities and total assets, you're not summing the column, it's just a number. Is there a reason why we shouldn't do like a sum?
Oh, okay, so this is a historical period.
Mm-hmm.
Okay. As you can see, the historical period for this one comes from my financials, the report financials as reported in Bloomberg. And I have the same for each line item. In the future, in the projections, yes, you're absolutely right. You want to do the addition for each of the three parts of the balance sheet. You want to do the total assets, will be the addition of 5 line items. Same for the liabilities, and same for shareholders' equity.
Okay.
And that's how we have it starting in 2012. Now in the historicals, the balance sheet needs to balance, so that's another reason why you still need that additional cross check. In the projection, you actually, this column here, this is projected. These figures are projected. These are generated by the model.
So we're thinking that this table was made in 2012.
In this case, the projected year is 2012.
Yeah, that's what I was confused with.
So you can see here 2011, you see there total assets is equal to financials 1, so that's the historical period. And 2012 is equal to the sum
Yeah.
of the line items. Okay? And in this case, the historical balance and the projection is also balanced. It's important that you fill the projection correctly, so that once you change your assumptions and you want to run sensitivity, so the investment case has changed. You change your assumptions, everything flows through, and your balance sheet recalculates. That's part of your modeling in Excel. You can see some examples there. And then the cash flow. Again, a very simplified cash flow, starting with the operating items, net working capital. Here, let me just spend some time showing you what each thing is, how each line is calculated. Your net working capital will be total assets minus total liabilities on the working capital side. So what this means is receivables and inventories on the asset side and payables on the liability side. So the net amount is assets minus liabilities. In the cash flow, what you want to look at is the change in the balance sheet year over year. So your first step is to calculate your net working capital, and the second step, the one that is incorporated into the cash flow, is the difference between this period and last period. So in this case, we have a growing figure, and because assets are positive and liabilities are negative, this means that you are investing more on the asset side. It is requiring an inflow, a net inflow of money, because it's an asset side. And because this period is larger than the previous period and we have an inflow, then the corresponding change in working capital is negative. So you reflect a negative or an outflow of cash in your capital. Okay? That's why, for instance, when a company is in a situation in which it has to slow down and decrease its level of growth, you will see that typically when you project those conditions, the working capital cash flow will increase because you're not being required to fund your clients, for instance, and instead of that you're collecting, so that is reflected in your cash flow. Alright, so that the working capital is the first cash item, the cash flow. To that we have the net income that we're bringing from the income statement. We bring the net income directly from the income statement. And to reflect the non-cash items that are already deducted at the bottom line, the net income, we add that back as well. You can build this many ways. You can also start with EBITDA, for instance, and then deduct all the other items that are below operations. Instead of starting with net income, it's the same. You're just reflecting the same line items in your operating side. The next part is the investment side. In this case, I'm not assuming divestitures or acquisitions separate from the total capital expenditures. So it's just one line. Typically it will be negative. You're investing, you're buying equipment, factories, plant, etc., software. So it's a net outflow. And at this point, it is very useful to see where your cash flow is, because this is your cash flow before considering any financing. If this is a cash flow positive business, then you're off to a good start. This is a good prospect. If it's negative, you have to be careful and you have to analyze your balance sheet and see how much leverage potential the balance sheet has, or if you will need in the future some equity additions and some dilution to your earnings per share. So in this case, you had a very negative year in 28, a crisis year, followed by a very positive year, etc. Here, these are the historical cash flows. I'll open up here on row 290 in just a second to show you how the intermediate calculations that are required to calculate the balance sheet and the cash flow. I'll just finalize walking you through the cash flow. We need to include the dividends. This is a negative. It's an outflow out of the company to the shareholder. Equity additions, when you raise equity, when you do initial public offering, IPO, this would be a positive. It's an inflow. Debt, this could be positive or negative. If you pay down debt, it's a negative. If you raise your debt, it's a positive. It's an inflow into the company. And then, those are all the line items. So we add them all up. Operations would be in blue. Lines 293 to 299. Investing would be just line 297. In this case, it's just capex. And then financing would be lines 301 to 303. So that's the net change in cash for the period. In the future, what you do is you have a beginning balance and a net change in cash. So the difference between the initial balance and the change in cash will be your ending balance. So that's what goes to your balance sheet, the cash line. Alright, so let me backtrack a little bit and go to the intermediate calculations that are needed in order to generate a future or projected balance sheet and projected cash flow. So I opened up, starting in line 267. The first thing that we're going to do is analyze the working capital. What we're going to do is translate the working capital items from the absolute dollar amount to a figure that can be used as a driver. In this case, what we're doing is we're translating those dollar amounts or currency amounts into days. How are we doing that? Accounts receivables. So it's 12.5. Accounts receivables are tied directly to revenues or sales. So you make a sale today, and you will give some terms to your customer. They'll pay 30 or 40 days from now. So we're doing that. We're simply dividing the balance sheet item, accounts receivable, by revenue, which is E164. That basically gives you a percentage. If the total revenues in a year is 100%, what percentage of that is your balance sheet item? That means how much are you financing your clients. And multiply that by the year, the number of days in a year, 365. So that gives you, that you're giving your clients on average almost 60 days. Or it is taking you 60 days to collect from them. And you do that year over year. So these are historicals. So as you can see in this case, the company has made some good efforts in terms of reducing the financing of its clients, which is good because your financing requirements are lower. You're reducing the asset side of the balance sheet, and that has a positive effect on the income. And what we'll do for the projection is take that number and use it as a driver. So now, instead of starting with the accounts receivable line, we already have a revenue line that we already calculated. We have an assumption which is 39 days receivable, and what we're going to do in the balance sheet is the accounts receivable line is going to multiply 39 days times revenues divided by 365. That will give us the projected accounts receivable balance. And that's how we start building our balance sheet. Okay? We do the exact same thing for inventories. So we have the historical period. Again, this is a company that looks good on those metrics. We want to see a company decreasing over time the asset side and increasing the liability side. So in this case, they're decreasing their inventories on average every year, more or less. And then going forward, we're just making a rough assumption to begin with, 49.9, 50 days of inventory. And with that, we calculate the inventory lines. And payables on the liability side, the same process. So we go here to accounts payable. In this case, just one comment, in the case of inventories and payables, this is more related to cost of goods sold. This is not related to revenue. You can tie it up to revenue, but it's more appropriate and it gives you a more precise projection if you do it on the basis of cost of goods sold. Because your inventories and primarily your accounts payable have to do with your suppliers. Okay. So that's for the working capital. For the again going back to the asset side, for the property, plant and equipment, we need to project this line here. So in order to sustain the revenue growth that we're projecting on the income statement, we need to keep up with our asset base. We need to have factories that have the capacity to produce those goods and services and products. So we have a couple of things. First, property, plant and equipment at the beginning of the period. Let's look at the historical period. And this is coming from the balance sheet from the previous period. Okay? And then we have the depreciation that has been charged for that period. And again, we're looking at historical. And we have capital expenditures. Again, this is historical period. What we are doing here is calculating the depreciation as a percentage of your property, plant, and equipment, because we're going to use that as a driver to calculate depreciation in the future. Normally, this can be around 10%. So, in other words, your depreciation is your asset base on a 10-year basis. And then also your capex. You want to have a historical reference in terms of how much you're investing every year as a percentage of your asset base. So 17, 12, 8%, 6%. And we're then going to use that as a driver to calculate capex in the future. And then we have the property, plant, and equipment at the end of the period for the historical section. Okay, what we're doing in the future is we're starting with, again, this is 2012, property, plant, and equipment at the end of the period for the last historical action, 2011, right? 63.260. We are making the assumption that the depreciation will be 12% of the asset base. That's why we're marking it in blue. So what we're doing is the previous year is the base, 12% is the assumption, multiply that base times 12%, and with that you calculate your depreciation. This figure, the depreciation, line 272, goes back, and I'm going to scroll up, goes back to your income statement. You go back to your cost structure. You can see here line 188, depreciation of non-cash, is equal to K272. So it's a function of the previous year's ending balance for property, plant, and equipment. It's running through your income statement. Then the next step is you're charging depreciation of your asset base. You need to keep up with that asset base and even expand it. So you're going to make an assumption, again, based on the property, plant, and equipment base, 63.2. Your assumption will be 12% of that will be your capex. This can be higher or lower depending on how fast you're growing your top line, for instance. And with that, you calculate your capex, how much you're going to invest in that period in your property, plant, and equipment. So therefore, you have your beginning of the period balance. You have the depreciation that has been charged and has gone through the income statement. So that you deduct that from the asset base. And you increase your investments during the period. So you add that to the asset base. And with that, you have the ending balance for the property, plant, and equipment. So we have two or three connections here. One I already showed you, depreciation goes back to the income statement. CapEx goes to the cash flow statement. We scroll down, you see here that capex line in the cash flow is equal to line 274, and the ending balance